Hi everyone, my name is Shelby, and today I'm going to be talking about sensitivity analysis and capital budgeting and why it's such an important tool for making really smart financial decisions in organizations. The goal and function of financial management. So first, at a really basic level, the whole goal of financial management is to maximize value. Companies don't just spend to spend. The entire purpose is to put money into places that actually grow future returns. So financial management isn't only keeping the lights on, it's really choosing the smartest way to allocate capital while still playing it safe with cash flow, liquidity, and good decisions early on, so what drive long-term success. So basically the key points is maximize firm value, smart capital allocations, manage risk and liquidity, and select projects that increase ROI. Why capital budget decisions matter? Capital budget decisions matter because these decisions are big, long-term commitments. We're talking about major projects, major purchases, expansions, tech upgrades, things you just can't undo. It's not like returning something to the store. Once the company commits this money, that decision is going to impact profits and cash flow for years. That's why the quality of the decisions directly shape in how strong or weak the organization will be later. So the big takeaway is big long-term commitments, they determine future profits, and you can't easily undo them, as well as quality decisions not equal stronger growth. What sensitivity analysis is. Now this is where sensitivity analysis comes in. Sensitivity analysis is basically a what-if test. We pick one assumption, we move it up or down, we see how that change affects the project results. This helps us see which assumptions matter the most. And honestly, this is super helpful because it's real world. The assumptions we make in the beginning are never perfect. So sensitivity analysis tells us how fragile or how stable a project really is. So essentially it tests what if scenarios, changes one variable at a time, and shows impact of uncertainty. Quantitative factors. There are quantitative things to look at. The numbers-based changes. These things are like revenue going up and down, cost changing, interest rate changing, or tax rate shift. This is the math side. The sensitivity analyst shows whether the numbers can hold up if the real world turns out different than the spreadsheet. So essentially, it shows the revenue changes, the cost fluctuation, discount rate changes, and tax rate shifts. Qualitative factors. But qualitative factors matter too. You can have a perfect spreadsheet, but a project could fail if leadership doesn't support it. If the market isn't ready, if the regulations change, or if stockholders hate the direction, these things don't always show up neatly in financial models, but they absolutely change risk level. So the big takeaway here is they need leadership support, market reputation, regulatory environment, and stakeholders' expectation. Internal methods. So companies use internal methods to evaluate risk. These tools inside the organization, like building different scenarios, doing break-even analysis, and even forecasting based on previous performances. Basically, it's the company's running its own stress tests on its own data. So essentially, internal methods to evaluate risk is scenario modeling, break-even analysis, and forecasting via historical data. External methods to evaluate risk. External methods are where company looks outwards, benchmarking against competitors, watching the broader industry, and paying attention to economic forecasts. Even if the project looks good internally, external market reality might make it too risky or might actually prove the project to be even more promising than it originally looked. So essentially, external methods to evaluate risk is industry benchmarks, competitor analysis, and economic forecast. So essentially, these are the references that I used for this PowerPoint. So when you combine all of this, sensitivity analysis basically becomes a bridge between what we think will happen and what might actually happen. It helps leadership think more flexibly. It helps prevent overconfidence. It helps commit capital only when it makes sense and not just based on the best case scenario. It makes capital budgeting decisions smarter, safer, and way more realistic. And that's really the whole point of all of this. is to make better decisions, better financial outcomes, and more future growth. And honestly, in real life, companies that don't consider uncertainty are the ones that get hit the hardest when the environment shifts. So sensitivity analysis isn't just academic, it's practical tools for protecting investments and making more confident decisions.